Welcome to ETF Market Insights, a weekly show focusing on the evolving world of ETF investing. Each Friday, a new panel of thought leaders aims to provide investment education and insights, with the goal of helping you become an informed investor. Make sure to visit youtube.com/ETF Market Insights to watch previous episodes. And remember to hit subscribe so you receive a notification when we post new content and when we go live each Friday. Thank you for joining us today. Let's get started.
Welcome back to ETF Market Insights. I'm your host, Erin Allen, VP of Online Distribution with BMO ETFs. And today we'll be talking about fixed income and really some key indicators to look at when constructing a portfolio. And this is actually part two to a series that focuses on what I would consider more advanced portfolio construction techniques, if you will. And in case you missed it, we had Alfred Lee on a few weeks ago, and he was discussing the equity side of this. So I will link that in the description below in case you missed it. But today we'll cover off sort of that other side of the coin when it comes to fixed income. So just a quick reminder today, we're not providing you any advice or investment recommendations. This video is all about providing education around ETFs and around investing in the markets for the Canadian do-it-yourself investor. So today I'm pleased to be joined by my friend and colleague, Matt Montemurro, Director and Fixed Income Portfolio Manager with BMO ETFs as we dive into the world of fixed income. So we'll cover off how ETFs have evolved over time. We'll look at interest rates and inflation and all of those hot topics. But Matt and I have worked together for almost a decade now, and he is an expert in fixed income. So Matt, welcome back to ETF Market Insights.
Thanks for having me, Erin. I'm excited to talk with everyone about the exciting world of fixed income.
Excellent. So let's just dive right in there. I think we'll just start off, if you could just provide sort of a review of the overall benefits of fixed income ETFs. I think that's a good place to start today.
Yeah, absolutely. You know, fixed income ETFs have really become a mainstay for investors as easy and efficient tools to get cost-effective diversification within their portfolios. You know, the main benefits of using ETFs for fixed income versus other products, like I can just list them off. You know, we got liquidity, diversification, transparency, they're cost-effective, and they're tax efficient. So I'll go through a couple more details of each of these and why they might be important to your individual portfolios. So the first one, in terms of liquidity. Fixed income ETFs, they trade on an exchange like a stock, allowing investors to take advantage of institutional spreads and pricing versus most bonds or fixed income instruments that can be purchased through a retail desk or your discount brokerage over the counter. So this leads to pricing efficiency and more liquidity to fixed income ETFs versus the underlying bonds. The second is diversification. A single trade gives you exposure, and in some cases, to thousands of bonds. So you get instant diversification. So you don't need to take any company-specific risk within your fixed income allocation of your portfolio. You can really diversify that risk away. Next, we look at transparency, and this is always a challenge in the fixed income market. You know, we talk about diversification, but what are you really buying? You know, what are the companies you own? What bonds do you own? Well, ETFs, we publish our holdings daily on our website, so at any given time, you'll be able to see line by line what you have exposure to. Next two is more of a cost perspective. So one is being cost effective in general. You know, fixed income ETFs provide this exposure at extremely low management fees. You know, that's a hard stop. That just tends to be more cost effective exposure on the fixed income side. And then finally, there are tax benefits and there are tax efficiencies that you can take advantage of by owning ETFs. So if you are a taxable investor, fixed income can be a little bit more punitive from a tax perspective than owning equities or stocks. So using or having options like discount bond ETFs allows you to maximize your after-tax returns. So something that a lot of investors can look at when they're exploring the plethora of fixed income options.
Yeah, I think they're really just a really effective access tool for investors. And we always talk about how ETFs democratize investing, and like I think fixed income is ETFs are probably the best example of that. specifically with different areas of the markets that you can target with emerging markets bonds. Like not many investors can go out and allocate to those areas themselves, and you're just getting that access, that better execution that you can't do on your own, which is so great. How have fixed income ETFs really evolved over the past decade? I think it's been, what, 13 years, 14 years now? How has BMO ETFs really been a big part of that? Not to toot our own horn, but go ahead, toot it.
So, no, traditionally, if you think about fixed income ETFs, they provided very broad-based beta exposure. So you're getting exposure to the entirety of the Canadian investment grade bond universe. So while that, for example, we have ZAG, our BMO Aggregate Bond Index ETF. It's the largest fixed income ETF in Canada. It's still a top asset gatherer. It's still the core of many investors' portfolios. But that was kind of the start of the fixed income journey from the ETF perspective. What we've really seen and how we've seen the market develop and evolve is the segmentation of the fixed income space. So you now have the ability to pick exactly the exposure you want along the yield and credit curve. So you can go short, mid, long, federal, provincial, corporate. That allows you to be more precise in your decision making. You can pick the exact exposure you want at a given time. Now, outside of Canada, you can also look to use ETFs to get, Aaron had just mentioned emerging market bond exposure, but you can look at complementing a Canadian-centric portfolio with things outside of Canada. So, that might be US Treasuries, it might be US investment grade or US high yield, it could be EM. These are all complements to the core of your fixed income. And ETFs, you don't have to be an expert at each of these asset classes or each of these asset segments to be able to put on that exposure. And that's very attractive and why we've seen the fixed income market evolve and grow as quickly as it has been, because that segmentation really gives investors flexibility in any market environment.
Yeah, and I think what we've also done is we've really listened to those allocators in the space, whether it's institutions or advisors who are using those more advanced portfolio construction techniques traditionally, and come out with these tools like high quality corporate bond exposures at QB or BBB corporate bond exposure that they've asked for in order to better target these specific areas of the market, and really just offering that to everyone is pretty cool. So we're obviously in a high interest rate environment, and that higher for longer mentality seems to really be setting in. The income is back in fixed income, but would love your thoughts on how we can manage that interest rate risk in the fixed income side of the portfolio, and what strategies investors can use when it comes to fixed income ETFs.
Yeah, absolutely. And I think the segmentation that we talked about in the last question, this is really where it comes and it starts to bear fruit. This is where you can use that segmentation for your benefit. That ability to slice and dice the universe, it allows you to pick and choose exactly where you want to be on the yield and the credit curve. And when you're in a high interest rate environment, a volatile interest rate environment, that segmentation can protect you from some downside risk, but also open up opportunities for what's to come. So, I think this segmentation allows you to better manage your interest rate risk. The risk you're taking. So, for example, let's have a real life example. If you think the Bank of Canada is done hiking and that they're going to be forced to cut rates in the near term, to stimulate the economy, growth slows down, you're concerned. So you think that they're going to cut rates sooner than maybe consensus. You may want to then add duration exposure to your fixed income allocation. And we have several BMO ETF options that you could use to do that. So, like I said, in that short, mid, long, federal, provincial, corporate, we have BMO Long Federal Bond ETF, ZFL, BMO Long Provincial Bond ETF, ZPL, and BMO Long Corporate Bond ETF, ZLC. All three would give you long duration exposure, again, fully diversified, but allow you to say, I think they're going to have to cut rates sooner, therefore I'm going to add duration to my portfolio. On the other hand, if you think the Bank of Canada will be forced to raise rates more, let's say you think that inflation is stubborn, it's sticky, and it's not showing enough signs of cooling, and that we're going to be in this higher interest rate period for longer, and that the central bank is going to have to raise interest rates more than maybe market consensus, then you might want to reduce your sensitivity to interest rates. You may want to reduce your overall duration in your portfolio. So in that case, you look on the short end of the curve, right? You can look at those same three options, except 1 to 5 years, short term. So BMO short federal bond ETF, ZFS, BMO short provincial bond ETF, ZPS, or BMO short corporate bond ETF, ZCS. This segmentation gives you the flexibility in a single trade to go from short to long, depending on your view. And I think that's become very, very attractive for investors, but it also gives you as an investor the power to take the interest rate exposure and the risk that you want to take based on your macro views.
And then there's the thought of even like barbelling that out, right? If you're,
Absolutely.
There's so many different strategies that can be considered. Inflation, let's chat a little bit about that. Still high, but obviously we saw signs in the US of some cooling last week on the latest read. But what are your thoughts here generally on inflation, and how can investors manage that risk in the fixed income side of their portfolio?
That is definitely the hot topic of the last 12 months. You know, inflation. We haven't really been able to get away from the inflation conversation. It's dominated investor conversations. It's dominated our conversations in just everyday life in line at the grocery store. You know, we've seen inflation peak globally to levels that we haven't seen since the 1980s. And you know, while the Bank of Canada, the Fed, but let's focus on the Bank of Canada here, they have made meaningful progress in cooling inflation, but I don't think the battle is won yet. We're still well above the Bank of Canada's target of 2 to 3%. And you know, I think we're going to continue to see, you know, blips up and down in terms of the CPI readings that may scare some investors. So, you know, as an investor, as someone who sees the impact of inflation in your grocery bill every month, a lot of people ask me, well, how can I hedge some of that risk? How can I manage some of that inflation risk from the investment side of my portfolio? So there are options that you can look at. There are securities that are called inflation protected securities. So these are US TIPS, so TIPS, that's Treasury Inflation Protected Securities. And in Canada, we have Canadian real return bonds that will provide you protection against inflation. And these securities are basically indexed to inflation and provide investors protection from any sort of unexpected inflation. So as a way to quantify what the market is pricing in for inflation expectations, what investors do is they look at what we call inflation break-evens. So that creates basically a break-even level of inflation comparing a plain US Treasury to a US TIPS, that inflation protected security of the same maturity. The differential in yield basically gives you an inflation level that would tell you, okay, this is the break even. At this inflation level, let's say 2%, I am indifferent between owning both of those securities. So how we interpret this and how we would enact this into your actual portfolios. If let's say use that 2% example. If 1 year inflation break-evens was 2%, if actual inflation is greater than 2% in 1 year, you are better off using a US TIPS. If actual inflation comes in lower than 2% in 1 year, you would have been better off using US Treasuries. So when you're making that evaluation, it's always important to look at where that break-even is and ask yourself, do I think inflation is going to be higher or lower than this price in 1 year from now? And at BMO ETFs, we offer several different options in terms of provide diversified exposure to inflation protected securities. The three main options: ZTIP, which provides US TIPS exposure, 1 to 5 or 0 to 5 years, so you get short duration. TIPS, which is the full term US TIPS exposure. So you're getting a duration of about 6 years, so a little bit more moderate duration there. And then you can look at Canada as well with ZRR, which in Canada, our inflation protected universe tends to be a little bit more longer duration, and that's a duration of 14 years. So you can combine your need to protect against inflation with your duration call by using any of those three options. And I think right now, looking at inflation and kind of my view of it being a little bit more stubborn and sticky, I think having an allocation in inflation protected securities is something to consider.
Yeah, and thanks for explaining that break-even analysis point. That's good for investors to consider. And the ZTIP and TIPS also available in USD, CAD, and hedged and unhedged. So that's all the options for investors. So we often talk about how flows can be used as sort of an indicator. We usually talk about equity ETFs on this channel, but we can look at fixed income too. So how can you use fixed income ETFs as market indicators?
So like you said, I think traditionally equity ETFs have kind of been used as kind of market indicators, but with the widespread adoption of ETFs and the increased usage of fixed income ETFs, we've definitely started to see a lot of investors, both retail and institutional, using ETF flows and ETF information to basically gather information about trends in the market. It's always useful for investors to know how other investors are acting in the market in the current environment. So you may have an investment thesis. Well, what does everybody else think? What are institutions saying? Am I aligned or am I on an island here? So I think we get a lot of those questions from investors. Is now the right time? ETFs can provide valuable insights here. By looking at something like a heat map of flows, monthly flows into ETFs or year-to-date flows, what you'll see is you can start to see the trend of where investor dollars are going in that segmented universe that we discussed earlier. So we publish a heat map based on that 3x3 matrix and then also adding the aggregate flows. And it basically will show you what segments of the fixed income market are gathering the most assets, which segments of the market are losing the most assets. Maybe you're seeing a trade that people are pulling money out of one area to go to the other area, and that may tell you something about your view on the market or the overall macro view on the market. So I think this is an extremely helpful resource to add to your investment process. It's free. It's something that it's out there. It's published by several different dealers, us included, and it's something that it's not going to make your decision for you, but I also think it can definitely help you feel confidence in that decision. If you, like, for example, let's give a real life example. We talked about adding duration risk. It's a scary thing sometimes thinking about adding a lot of duration, adding interest rate sensitivity to your fixed income portfolio. When's the right time? So I've had a lot of investors mull this over, but if you're looking at ETF flows, year to date, the number one asset gatherer in the fixed income space outside of cash is long duration products, specifically ZFL, long federal bonds. So that tells me that if I had that investment thesis about adding duration, and I see the amount of flows in the hundreds of millions that have gone into ZFL or long federal bonds, that tells me that there's institutional and retail investors who have the same view as I do, and that's a trend that we're seeing in the market. So again, it's not to make the decision for you, but it's something that you can definitely add to your investment process that will help you cement or stress test your potential investment thesis. And I think that's something to ask yourself. Does it align with my thinking? Does it contradict it? What does that tell me? And I think ETFs as useful indicators, they're becoming more and more widespread and more used by a differentiated user base, both retail and institutional. And because of that, there's a lot of information you can gather from it.
Yeah, and I think you can use it sort of to check the sentiment too, right? Like obviously we've seen a ton of money flowing into cash. Well, what's that telling us about what investors are thinking? I think that's pretty obvious, but definitely some good points there. So to close out, just sort of a general question, a loaded question, would love your sort of outlook for the fixed income market, what we can expect for the rest of the year and into next year.
Oh, you want the crystal ball?
You had a crystal ball, yeah.
Just looking back before I look forward, we've been on a little bit of a wild ride over the last, let's call it 18 months. 2022 was an extremely challenging year for all markets. It was only the third time in 150 years that both bond and equity markets had negative returns in the same calendar year. So if you think about that, we're talking about twice in a lifetime type event that we saw last year. So, as we've moved into 2023, I think a lot has continued to happen. But I do think that there continues to be excellent opportunity for markets, especially for fixed income investors. We've seen the Bank of Canada and the Fed both pause their interest rate hiking regime. Just recently, the Bank of Canada ended that pause with a bit of a surprise hike in June and maybe another hike in July. But I think, as we've been saying for some time, our view is that we're still nearing the end. We're closer to the end of the hiking cycle versus the beginning. And I think that makes sense, just seeing we went from 0 to now 475. You're not going to get to 8%, but we could see a couple more hikes. But all in all, I think we are nearing the end of the hiking cycle, which should bring more stability to the market. That being said, we do feel like we are going to see higher rates for longer. I think that is something that we are quite firm on. We don't expect any near-term rate cuts. Our estimation is that, my estimation is that inflation is going to be more stubborn and more sticky than the market expects, and we're going to have higher rates for longer to really combat these inflationary forces. So what that generally means for markets then is that we're probably going to see a slowdown in growth. We'll probably increase the likelihood of a recession, because it's going to take quite some time for all of these rate hikes to make their way through the economy and really make a lasting impact. I think in general, these hikes take about 18 to 24 months to take full effect. We're in month, 12, maybe 15 of those early hikes. So there's still lots of room that those interest rate hikes have to make their way through the economy in all facets to really tamper and cool all the inflationary pressures that we're seeing. So if that's the case, how do you position your portfolio for the period ahead? I would look at we're seeing an inverted yield curve, meaning that short-term rates are significantly higher than longer-term rates. That tends to be an indicator of that a recession is on the horizon in the next, generally they say 6 to 8 months. I'm in that view as well. So what I would do is I would look at the short end of the curve. I would see yields at 5+% for investment grade, either credit. Sometimes in money market, you're getting close to 5%. Investors are quite literally getting paid to be in cash in money market and short-term fixed income exposure. We haven't seen these type of environments since the early 2000s. So I favor corporate bond exposure. I think there's opportunities in spreads, and they continue to be well wider than 10-year historical averages. So that tells me that the market's already been pricing in a slowdown in growth. So for me, I love credit and corporate bond exposure in the short end or ultra short end. I think it's a winning trade to get very little risk, and you're still getting a 5% yield. That's a very attractive risk return payoff, in my opinion. I would also look at credit as a whole. I favor investment grade credit over high yield. I think high yield will face some headwinds in the period to come. I think there's going to be a lot of refinancing risk for high yield issuers, and I think we might see a little bit of a cleansing of the high yield market. I think default rates will trend toward 3 to 5%. Right now they're around 2%. So, I think we're going to see, I think that's a good thing. That's part of the economic cycle. We've really pushed this, 8-year economic cycle. We've been in a 12-year, 13-year run now. So I think a little bit of a cleansing of high yield is a good thing. So I favor investment grade credit in the short end. And to be honest, to complement that, and Aaron, you alluded to this earlier in terms of that barbell, I like adding duration, not as much like as an interest rate call but more so as a ballast to my portfolio. So if I think there's going to be a growth slowdown, if I think there's going to be a recession, that's likely mean that the equity part of my portfolio is going to have a pullback in returns. And what I want to offset that is that long duration exposure. You're going to expect that rates will be forced to get cut at some point, and that long duration exposure will provide that equity market volatility offset. And that's what I want in my portfolio. So, having short-term credit, taking advantage of those higher yields, complementing it with some long duration government exposure, whether it's Canadian federal bonds or US Treasury bonds. I think both would be very well positioned for the environment ahead, and hopefully to really wait out some of the volatility that we're expecting to see in the next 6 to 12 months.
Perfect. Thanks, Matt. That was a great overview and some good strategies for investors to consider. I think fixed income is definitely on the minds of a lot more investors these days than it was, say, a year ago, right?
Absolutely.
Yeah, so that caps off another great week. Thanks again, Matt, for joining me. Next week, we'll be taking a break as it's Canada Day long weekend. So happy early Canada Day to everyone out there. We'll return on July 7th, where we'll be doing a deep dive into the new and highly anticipated all-in-one covered call ETF, ZWQT, or the BMO Global Enhanced Income ETF. So really looking forward to providing all the details around this new solution, and I hope you'll join us then. Bye for now.
Thank you for watching this week's episode of ETF Market Insights. To stream any previous episode of ETF Market Insights series, please visit youtube.com/ETF Market Insights. Remember to hit subscribe and sign up for alerts so you know when we post new content. Also, we invite you to visit our accompanying website for ETF tools, education, and much more at etfmarketinsights.com. Once again, thank you for watching. The session provided is for information purposes only. Any reference to a particular company or product is for illustrative purposes only and should not be considered as investment advice or recommendation to buy or sell. Particular investments and/or trading strategies should be evaluated relative to the individual's investment objectives, and professional advice should be obtained with respect to any circumstance.